Well, good evening, everyone. And thank you very much. Thank you, Frank, for your nice welcome back. And thank you, Dan. I really wanted Dan to introduce me because then I didn't have to adjust the mic down. So that worked out really well.
Stand up, Stu.
That's a swipe for both of us. As Dan said, my 6th year coming back here, and this is a great group. And you have a wonderful organization, wonderful leadership, and a very, very active chapter, and an active organization. And we heard earlier about your role in trying to represent the interests of your members in the tax bill that was recently passed. What I want to do is what I always do. I was last here on, I believe it was April 16th of last year. And as you say, 5 years or 4 years prior to that. So for any of you who were here there, or here at that meeting, and then had the audacity to remember what I told you, I'm going to remind you, at least the things that I remember saying, that coincidentally just happened to be correct. And then we'll move on to what have you done for me lately. I was pretty positive about the outlook for the economy, worried about whether the Trump administration was going to pursue trade protectionist policies, which frankly they have not, although there are some things pending there, certainly the NAFTA agreement. The deregulation we expected, not just in the financial industry, but across the economy, we thought would be positive. And I did talk about what I thought would be a tax cut that would be enacted and take effect in 2018. And here we are. Of course, there are many other things that have gone on in the administration. Healthcare, Obamacare wasn't repealed and replaced. But I guess as you know, the individual mandate went in the tax bill. And of course, the market has done extraordinarily well, as not only the Trump administration, but the combination of that and the Republican-controlled Congress has been much more business-friendly, pro-business environment, culminating, of course, in the tax cut at the corporate and individual level. We talked about the Fed last April. They had raised rates once in March, just before I was here, and I predicted they'd raise them 2 more times, and they did. And we thought interest rates would be moving up, and therefore, frankly, bond market was a place to be defended. And of course, for those of you, and many of you in here, who do finances, that probably a time to hedge against rising interest rates. Well, they haven't risen dramatically, and it's been gradual. It has been persistent, and it hasn't ended in December. Talked a bit about the stock market. I was quite positive. Of course, I didn't think the market would go up as much as it did, but under promise and over deliver. That's a good strategy. I'll probably do that. By the way, in my own position, a year ago I was the chief economist at PNC. Now I'm a senior economic advisor. Fortunately, nobody at PNC knows what that means. It's sort of like an emeritus chief economist, and it means generally I don't get into work that early and I don't wear a coat and tie, so it wasn't such a bad deal. But I'm glad to be back for this group, and I am still working full-time for PNC, and I guess I would call myself a brand ambassador to try to sum it up, and certainly outreach with clients and the media and wonderful organizations like your chapter and the FEI nationwide. So those are some of the things I told you last year, or not quite, it was last year, but not quite 12 months ago. But what's the status now? And that's what I want to do. I want to talk to you about the economy, as I always do, put it in a global context. One of the things we talked about last April was the global economy and global central bank policy. The one thing I'd say I was most surprised, at least relative to what I told you, is the dollar was a lot weaker. I didn't think the dollar would be as weak as it was in the last 9 or 10 months. And we'll see whether, if you catch a bid or not, but so far it hasn't. So we'll talk about now the outlook for 2018 and even into 2019. I'll talk to you about the market. We have a change in the Fed chairman. I did predict that Yellen would not be reappointed. But basically, in appointing Jay Powell, the president picked what I'll call the continuity candidate. Jay has been at the Fed, I think, for the last 5 years. He's voted with majority. He's been a close confidant of Chair Yellen. And he should be sworn in, very soon. And Yellen's last meeting will likely be the one at the end of this month, and then her term expires in the opening days of February. And there are a number of vacancies on the Fed, and we'll see who else the president nominates to fill those vacancies. So we'll talk about the outlook for the markets, put it in a global context. I'll give you some of our thoughts about stocks and bonds, and then I'll end as I try to do a little bit about Chicago, about the metropolitan area here. You have there a handout. It's a little bit dated, but this was our small business economic outlook we did actually right before the election. We're in the process of doing it right now. We'll be in the field probably in early February. So I'll have an update for you. I think last year when I was here in April, we had just published it because it usually comes out at the end of March or early April. But, for those of you who are interested, and of course, many of you are good clients at PNC or prospects, and we greatly appreciate the confidence you have, and you know Dan and Kelly and other members of PNC, my colleagues here, will take excellent care of you, and I hope they will, and you're with a very good company. I've been with it for almost 38 years, and if any of those guys don't do a good job, just let me know. I'll summarily have them fired, and we'll replace them with somebody much better. But I don't think I'm going to need to do that, and I don't think we're going to find too many people any better than those we already have. And then we'll end, as I say, by talking a little bit about this region. Open up a little Q&A, right? What time does everybody want to be home? I guess 10:30, 11, something like that. Is that today or tomorrow? Is that AM or PM? I think we can do this in less than a half hour, and then wrap it up, as I say, with a few of your questions. So what is the outlook? Well, we've been in economic expansion for 8.5 years. It has lacked a lot of strength, but it has, I think, made up for that in length. Because usually economic expansions don't last more than 5 or 6 years, or at least over the last 6 decades. And to be honest, as I look around, I don't see any of the signs of, call it decay or problems that would suggest an end to this economic expansion is within sight over the next couple of years. Now, no doubt things will change, and I don't know what will happen in North Korea, and I don't know if the president will pursue more stringent trade policies, which I think, as I told you last year, would be a lose-lose. But as I look around at inventory levels, at consumer and business confidence, of course, the tax cut, frankly, the financial health of consumers, businesses, and banks, I don't see the excesses that I would normally see before a recession. We don't have an inverted yield curve, which I know a lot of people have talked about. It's certainly flattened, but that's not surprising, and I don't see it inverting in the next couple of years. So the things that I look for, if you go for a checkup and the doctor looks at your heart and your liver and your enzymes and your blood count and all the CBC, as best as I can tell, like Donald Trump, we have a very healthy, stable, genius economy before it's here. Now, that's not to say you can't die of a heart attack the next day, but right now the odds would suggest that isn't very likely. So our outlook is relatively positive on the U.S. economy. Indeed, economic growth, last year, we haven't gotten the data for the fourth quarter, but it was the best holiday season we've probably seen in at least a half a dozen years. And I think as we get data in the fourth quarter, and particularly we've already gotten some data on holiday sales, and we'll get the GDP number in, I guess, less than a couple of weeks for the fourth quarter, and capping off all of last year, economic growth was pretty solid, probably around 2.5%. And for this year, we've upped our forecast. As I say, we expected a tax cut. We didn't know the, obviously, specifics and particulars. And as you said, there may be some technical corrections needed if that can get done. But we upped our economic forecast by about 0.5%. And I heard Bill Dudley, the chairman of the president of the Federal Reserve Bank of New York, and other Fed presidents have upped their forecast now that, you know, the tax cut is in law. But not just that. The momentum in the economy and these other relatively positive signals we're getting. So we think we might get 3% economic growth this year. And I know there are some that say it'll be 4%, and I'm very dubious. I'm sustaining 3% for 10 years. So that when I hear some of the claims, frankly, coming out of the Congress and the administration that, you know, economic growth is going to be the long-run trend is going to go from 2% or even under up to 3%, especially given some of the immigration policies, I have trouble with that. But I think for the next couple of years, the tax cut is a stimulus, but of course it's going to add to the deficit. And so I'm not saying there won't be some payback from that in years to come, but probably not in the next couple of years ahead. So 2.75% to 3% GDP growth versus about 2.5% last year and versus 2%, give or take, for I think the previous 6 years. From an unemployment point of view, we're down to 4.1. We think that's gone down to probably 3.5% to 3.75% by maybe the end of this year. So another, couple of tenths or a tenth every other month on average. We keep going down. We think we'll add probably 1.5 million jobs this year. That's not as many as last year or the year after, but I think most of you in this room, and I expect you to nod your heads like this when I say one of your greatest problems is finding qualified employees. And those who have the skills, the experience, some cases can pass a drug test, and who can show up at work. So that's a bigger problem. And then we might even have a bigger increase in jobs. But when you're into a 9th year or a 10th year, if we get there in 2019, and I think we will, and the unemployment rate's under 4%, and you have a limited immigration and a low birth rate, well, it's not so much the birth rate, but the persistent birth rate, so that the people who are 17, 18, 19, 20, that are even a little older, that are going to come out of college and enter the workforce, these are not large numbers. So that's probably more a constraint. Now we do think productivity, which has been lacking the last couple of years, other than of course in this room, we think we're going to see some improvement in that. But it's been so dismal, 0.5%, 1%. Hopefully it can get up into the 1%, maybe not 2% range. And by the way, with that, we will see bigger wage hikes. So dropping the unemployment rate, maybe 1.5 million more people working. You can do the math, so that's about 120 or 30,000 a month. Last month in December, we had 148. Initially seemed to be disappointing, but that's probably more what numbers are going to look like. It's going to be pretty hard to grow jobs over 200,000 a month, maybe in any given month, but certainly not on a persistent basis. But it's probably true that to get the unemployment rate down, given the labor force growth and the immigration, if you got 75 to 100,000 jobs, that would probably keep the unemployment rate at 4.1%. If you get the 125 to 140,000 a month that we're talking about, that's how you get the rate down towards 3.7, 3.6 a year from now. And I think we will see more wage increase. Now that's we've seen all these one-time increases. I'm glad to say PNC is part of it. Out of the 55,000 of people that work for us, 48,000 are going to get a $1,000 bonus. And of course, Walmart and other banks and waste management, we've seen a number of finance and non-financial companies, announcing one-time bonuses or wage hikes, minimum wage, and increases in some pensions. So I think that is a sign that the corporate tax cut, some of that is going to get passed through, but that the general tight labor market is what's driving that. If you'd had that corporate tax cut 4 or 5 years ago, when the unemployment rate was 7%, and frankly, we probably would have been better timed, I don't think you'd have necessarily seen, it's counterfactual, but I don't think you'd have seen all these one-time bonuses because companies probably would have not felt in that kind of labor market environment it was all that necessary. But in this, it's necessary, and it's certainly a way to share some of those tax cuts with your loyal and hopefully productive workforce, like all of us in this room, that have been working for these companies and doing well, and they want to retain us. So I think you will see faster wages, maybe 2 3/4 to 3%, maybe a little higher than that. Now, from Dan and Kelly, I want you to realize I'm not talking about PNC. You and I will continue to get no increases whatsoever, which will match our productivity gain, absolutely nothing. But for the rest of you who are productive and work in productive companies, you probably will see some wage increases, and hopefully maybe, as I've already said, we're going to see that in our company as well. What's going to contribute to economic growth? Well, I do think the consumer. We're going to get an individual tax cut. Consumer confidence is at a high level. Balance sheets are doing well. House prices are going up. Stock prices are going up. Income's going to go up with that kind of even, $1.5 million for jobs and some faster wages. So what is it that we say drives consumer spending? If you did an equation, income, usually job growth, consumer confidence. Then we talk about a wealth effect. That's what you all learn, and many of us would teach at University of Chicago or any place else. Click, click, click. They're all in the positive category. But also business investment, which was sorely lacking until around the middle of last year, is also likely as a result of the tax cut, but also a greater demand, both technological and even some increase in capacity utilization, likely to drive some business investment over the next couple of years. Some of that, as we saw from Apple, can be funded by overseas profits that have been there, although I suspect Apple is certainly not financially constrained, but I think other companies as well, and that will add to, they're going to pay $38 billion in taxes to the federal government. So that will help, at least partly offset some of the revenue loss that's going to come from the lower corporate tax rate and lower individual tax rate. So the deficit's still going to go up. It's just those types of activities will, mitigate the extent to which the deficit widens. So we think business investment is going to make a much bigger contribution to the short run and over time through productivity and better technology and the growth of the economy. But as I said, I can't get it saying that we can get to 3%, kind of like we did for the 20 years, maybe after World War II, or maybe the 5 or so years in the 1990s. We did have a growth potential that strong. I don't think it's going to be there. But if we can even get out of the 2% rut, so to speak, that we're in, and I think we have, into the 2.5% and 3% for a couple of years, that would be very positive. This will also happen in the context of a global economic recovery. I'm sure many of you do business and travel around the world and sell and import, export and import. And when you look at what's happening, Europe grew 2.5% last year. It's the fastest they've grown in over a decade. And particularly continental Europe, because Britain is still suffering from Brexit. But Europe's probably going to grow 2.5% this year, meaning they grew about what the U.S. did. This year, we think the U.S. will step up the pace and outgrow Europe, but that would still be probably the best back-to-back years in Europe we've seen in 20 years. In Asia, even Japan's showing some growth. China just announced their GDP numbers, in the high sixes. It is what they say it is. So, they can tell you what their economic growth will be in 2018 on January 1st of this year. 6.7. 6.72497318. But China is doing well. India is growing well. Vietnam, Taiwan, Indonesia, Australia. So Southeast Asia is going to be probably some of the strongest growth we've seen there. As I already mentioned, Europe. North America, Canada's been outgrowing all of us. Now they may not be able to keep that pace up, but probably the fastest growing developed economy over the last year or two has been Canada. Now the Bank of Canada just raised their rate yesterday. The Canadian economy will probably slow down a little, but the Canadian economy will do quite well. And some of that is domestic, but certainly the U.S. economy and the trade we do with Canada, major caveat that we don't rip up NAFTA. And who knows what's going to happen there in the next couple of weeks. Mexico may not do as well, but with oil prices at over $60 a barrel, that's going to be a lot better for the Mexican economy than it was in oil at 30, let alone auto sales and other activities they do. And then we'll go to South America. South America, led by Brazil, has been in depression for the last several years. Brazil finally is growing again from an extremely low level. And with commodity prices doing better, you're seeing Chile, Peru, Colombia, Argentina, forget Venezuela, but the other parts of South America doing well. So if the Americas are growing, North and South, and Europe is growing, and Asia is growing, I think we're going to have the fastest global economic growth this year we've seen in, over a dozen years. And that is a positive. It helps the U.S. sell products abroad, and of course it helps those countries to have the U.S. doing well and many of the other trading partners, because the U.S. now accounts for about 40% of GDP, global GDP, 10 or 15 years ago was 60%. So we're still 40%, we're still the biggest. We're still bigger than China, and probably if you had China and Japan together, they're about our size. And if you added all of Europe together, they're about our size. But, 40% of global economy is not what it used to be, but it's a very positive, synchronized global economic development. So consumers are doing well, and businesses are investing. Productivity is a little better, wage growth is a little faster, jobs are growing, and we see good exports going to a global economy. That's like the main cylinders of the economic engine. Maybe government spending, state and local government spending isn't as strong, although it looks like if we're going to kick $50 billion in defense spending and probably some, a significant amount into non-defense spending, which of course will worsen the deficit short and longer run, but in the short run, even government spending, state, local, and federal, is likely to add to economic growth. So I don't know what I'm missing. Maybe North Korea. Maybe we do have a trade war with China, or we do rip up NAFTA. Those are the biggest risks that I worry about in the global economy. But are they likely? Are they probably enough of a threat to undo what seems to be a pretty strong outlook? We all do it. You got to make a decision or a forecast. You put the pros on one side, the cons on another. That's the way we used to do it. And when I put the pros that I've sort of listed versus the cons, the pros have it. And that's not only for this year, but I think the next couple of years. And, certainly a year or two from now, things could turn. Oil's at 70, or I guess Brent's about $70 a barrel. WTI 64. I worry about that. I think it's good that I think a sweet spot for oil is probably $50 to $70 a barrel. Below that, like we had a couple of years ago, that actually hurts producers, and as we saw, that's an important part of the economy, the whole oil, energy, natural gas production. and the economy was weak. It was 2 years ago. Remember where we were 2 years ago? 2 years ago, the stock market was cratering. Every day, the market would go down 200-300 points. Oil prices were below $30 a barrel. And the feeling, or we didn't believe it, but this feeling around is, oh, the economy is on its last legs, that it's headed to recession. And the Dow was down, what, 12, 14%. Small caps were down over 20 in our, quote, bear market. And when it became clear that the economy wasn't that fragile, and some of the bearish concerns were way overplayed, 2 years ago the market hit bottom somewhere in February. And so, you know, the economic fundamentals were pretty good. So we don't want oil at $30 a barrel. But if it gets above 70 or towards 80, I worry that's, you know, quote, too much of a good thing. It means gasoline easily goes over $3 a gallon. We haven't seen gasoline over $3 a gallon, national average, in a number of years. It means companies that use a lot of energy are going to see their costs go up. It means inflation is going to go up in the headline, and some of it will creep into core, and that's going to put more pressure on the Fed, who I'm going to turn to in a minute. So yes, a big run-up in oil, a problem in North Korea, trade protectionist policies, you know, they're all out there as potential negatives, but I would say given the odds and given the positives, you still say the most likely outcome is a pretty good economy and some pretty good economic growth and job growth over the couple of years. So what's the Fed do to turn to them? Well, Jay Powell's going to take over as chair of the Fed in the next couple of weeks. Yellen's last meeting will be at the end of January. Jay is the continuity candidate. He's been on the Fed for 5 years. He has worked closely with Yellen. So as opposed to a number of other names that were, you know, at the time talked about that would have been more disruptors, the president really picked somebody who's going to continue the policies. So you're not going to have sort of a settling in. He's been there. And he's got support, and I think he's a very good person for the job. But we don't think that the Fed's task of raising rates is over. So this year we think the Fed's going to raise rates 3 times. Maybe 4. I'd say 4 is more likely than 2. And the market is priced for 2. If you do futures markets or swaps or hedges, it's based on the idea that over the course of the next 12 months, short-term Fed funds rate will go up 50 basis points. I'd take the over on that. And so to the extent you might want to hedge against that, when the markets give you that opportunity, that's probably not a bad time to do it. And I have the name of somebody who can help you do that at PNC for a very reasonable, almost insignificant fee, half of which goes to them, half of which goes to me. And I guess Kelly gets a little bit of it as well. But we would still be hedging. And that's why we're defensive from an equity, from a stock wealth investment portfolio. So I think the Fed will probably raise rates. March is on the bubble. Won't be January. March is on the bubble. Maybe they wait till June, but somewhere over the course of the next year, you're going to get 3 rate hikes, 0.25% each. So short rates, instead of being about $1.40 today, will be over 2%. And the yield curve will flatten. But I don't think it'll invert. I don't think a 10-year is going to be below a 2-year, definitely, in my opinion, not below a Fed funds rate if it's 210 or 220. Right now, the Treasury just sort of, I don't say broke out, but it pushed up a little over 260. Our view is that maybe by the end of the year, it'll still be below 3. Maybe it'll be up 30 or 40 basis points from here, and the yield curve will flatten, but it won't invert. And by the way, we don't think that's the end of it. In 2019, we think the Fed probably has another couple of rate hikes before they probably reach some, I don't know if I call it equilibrium or some rate that really is more in line with historical averages, which would probably be short rates around 2.5 to 2.75%. And by the way, the Fed's own dot plot, their own consensus forecast, is for 3 rate hikes this year. So we're not saying anything other than we think the Fed might be right for a change. And you know, that's a heroic assumption, but that's what we think will happen. And then they talk about even 3 rate hikes the year after, 2019, maybe 2. But over the next 24 months, we think short rates are going up somewhere around 125 to 150 basis points, and long rates will go up much less, so the curve will flatten, but it will not invert. So from a financing point of view, if you can protect yourself against that, especially when the market is building in less of a rate hike, we think it's a good thing to do. From the stock point of view, we've been 65-35 stocks bonds for a long time. But within that 35, I've told you for the last couple of years, very defensive. We do a lot of adjustable rate, we've done some tips, and we've had our duration below the average. And nothing would make us change that or have. So we still want to be short duration, we still want to be in tips, we still want to be in variable rate, because we do think that, as I say, even they won't go up as much as short rates, 5, 10, 2-year treasuries, and probably corporates, because the spread in corporates to treasuries is so narrow. And some of that reflects, the good outlook for the economy. So jump spreads and quality spreads have narrowed. They can't get much narrower. So if those rates in the treasury goes up, you'll probably see corporate rates go up as well. And then at some point, one of the classic signs when we get near a recession is those spreads will blow out. And that'll be something we'll be looking at as saying, hey, the market is smelling out some credit problems and some of the lesser quality corporate spreads relative to treasuries will start to widen. But that's probably not going to happen that much in the next year or 18 months. So we still like the stock market. Hard not to like it. It goes up an up day for the market is when it's flat. I'm sorry, a down day for the market is when it's flat. Today the market was flat. That's the new down. Flat is the new down. Now, of course, the market is so overdue for a correction. And, 5-7% wouldn't bat an eyelid. It sounds like a lot of points. That could be, 1,500 Dow points. That would get your attention, but that would be normal. The fact that last year the market's biggest decline was for 3% is so out of line with historical averages, and the fact that the volatility, the VIX, was below 10. That is nirvana. And at some point, something disturbs nirvana. So we think, it's not a hard call to say this year will be more volatile on both the up and down side, because, last year hardly was at all. But to see a bear market where stocks go down 15 or 20% on a persistent basis and take years to get it back, we don't see it in the next couple of years. But a correction, 3, 5, 7%, which we think would be an excellent buying opportunity, could well come along for any reason on politically, geopolitically, sentiment. Even Bitcoin can go down, so I guess the stock market can go down. If Bitcoin can go down, then maybe the stock market can go down. And in fact, if the stock market did go down, my guess is it would really hurt Bitcoin as opposed to the vice versa. But we're not recommending Bitcoin, and I've stopped taking Bitcoin in exchange for my presentations. Although I wish I had over the last couple of years, because it's probably been a lot better than anything else you could have paid me with. Not that I really get paid. So we like the market, and we still think the stock market looks pretty good, and if there's a correction, it's a buying opportunity. And I'm not an individual stock person, and I'm not going to try to say we like technology better than financials, or we like this name better than another. We have plenty of very good people at PNC who I still work very closely with that do the portfolio structure and the industry structure and overweight and underweight. Certainly we're underweight in utilities and REITs and other interest sensitive types of stocks, and we think the banks, and we think the technology side, and some of the capital goods stocks, and some of the stocks in the consumer area that particularly global are things that we like. But many of my other colleagues, that's what they do for a living. I try to talk about sort of the bigger picture and let them kind of get more granular with our wealth management clients. So let me end by saying a little bit about this region. Took a look at what I told you a year ago about for the Chicago metropolitan area. We forecasted you'd grow jobs about 1%. you have about 4.6 million in your workforce. You fell a little short of that. Looks like it was around 0.7. Although I tell you, in March, they revised all these data, and who knows? I mean, if they'll get more complete records, but the going estimate is that you added about 22,000 jobs, 25,000 on a base of 4.5 million. You can do the math, that was around 0.6, so a little less. The unemployment rate has come down, average last year around 4.5%. Towards the end of the year, it actually, the latest numbers we have, ticked up towards 5. But on a regional level, the unemployment rate is much more volatile month to month than it is at the national level. So some of that movement up in the final quarter of last year is probably not a change in the direction that has been going down, but maybe, the one step back on the two step forward. House prices appreciated about 3.5%. That's below the national average, which was closer to 6. House prices in the region are back, using the Case-Shiller index, probably back because they peaked in 06, and then they started falling. They're probably back to about 2008. And not surprisingly, in many markets, they're now record highs for house prices. Now, the tax bill, not here to talk about it, about that, could be a problem for some higher-ended homes in obviously states where you have high state and local taxes that are no longer deductible. So that could put a damp on some of the extraordinary price gains and to levels in a lot of markets in New York, and not so much in Chicago, but in New York and obviously California and even places like Atlanta and some places like Florida, although they don't have the state tax to worry about, but the lack of deductibility and the cap on the amount of, was it $750,000 on principal and interest expense. So the region, though, it continued to grow, but your pace was a bit slower than the national average. But given my view that the national economy for the next couple of years is pretty good, we're actually expecting job growth to accelerate in this market. We're now thinking you'll get back up above 1%, which is about the national trend. That 1.5 million I mentioned, we have about 140 million people working, so do the math again, that's 1% in round numbers. And we think you'll get there, so that could be about 45 to 50,000 jobs in this market. Home prices likely to those stay in that range of 2.5–3%, and we like to think that the housing market will do better in home sales and starts as we see nationwide. Personal bankruptcies are down in the region. We think they will continue to go down. So, and the unemployment rate should be down. Probably it won't be as low as the national rate for a variety of reasons. As I mentioned, we think the national rate could get down to 3.5 to 3.75. Maybe in Chicago, it's more like 4.25 to 4.5%. So we don't think it'll fall under 4, but as I said, it ended last year about 5, and we think that's an overstatement. It'll work its way back out into the mid to low 4% as those 45 to 50,000 jobs, if we're right about that forecast, materialize over the coming year. So it looks, fairly good for the region. It's not outgrowing the U.S. It hasn't done that. We're not saying it's going to. There's no reason to think that the Midwest in general, and Chicago, the powerhouse in the Midwest, is not going to continue to grow at probably a little better pace this year and next, as the national economy is expected to do in some of the key metrics that matter, that we have data at the regional economy, and jobs and wages and unemployment is kind of one of the key metrics. So let me stop there and sum it up. It's right at about 7:30. I think that's Frank when you said you stopped paying me, so I'm not paying much. I'm 7:30. You see, as I think I like the kid, I'm a cautiously optimistic economist. I've been that way over the last couple of years. I think it's panned out well. Of course, the zigs and zags in the economy can always throw you off, but those who are quite bearish on the economy and think we're headed into a recession or that interest rates are coming down, I think they're just dead wrong. Those that are over-exuberant about 3% growth on a sustained basis for 4 or 5 years is going to greatly reduce our deficit, I think they're wrong. One of the reasons we think rates are going to go up is, and particularly at the longer end, is we're going to have a much bigger deficit. And the interest expense on the deficit is going to go up. as interest rates go up. So we think that's another factor pushing long rates up, not as much as short rates, but to argue that the long rates going back down to 2% or 2.25% just seems to us to be totally contrary to what happens if the Fed's raising short rates and the federal government is financing even more at the same time that the Fed is also reducing its balance sheet. Did I forget to mention that? That the Fed is raising interest rates and continues in an orderly fashion to shrink its balance sheet, which means you're going to buy fewer treasuries and then even let some roll off. So the supply of treasuries is up. The Fed isn't going to be buying anymore, is actually going to be selling some. We think inflation will be a little higher, getting closer to the Fed's 2% target. If that doesn't take longer term rates up, then throw away the models, because those are sort of all the factors that suggest that the rates, both short and long, ought to be going up. Cash will look a little better. You might actually get something that's not fractional. You might actually get something that starts with an integer. 1 on your money funds and your bank CDs, and maybe even 2 by the end of a couple of years. But in that environment, that should favor equities. And if we do get a sell-off, it's a buying opportunity. And finally, this region, I think, is poised, or remains poised, to grow at a maybe even a little better pace over the next couple of years, mirroring the improvement in the overall U.S. economy. So on that note, again, I thank all of you for coming out this evening. I thank you for inviting me back. It's a great organization, and even in my new role, when Dan called and said, "Could you do it?" I said, "Sure, I'd love to fit that in and be here." So thank you very much. Thank you for your attention. Thank many of you for the business and confidence you have in PNC. I'm going to stop there and open it up for a little Q&A before we all go home and, take it easy for the night. And I see a couple of hands going up. We'll start with you right in the back. Yes?
The U.S. dollar relative to other major currencies has tanked in the last year or so. Do you see that continuing, or what do you foresee?
Yeah, the question was about the dollar. I guess I glossed over that. I did mention to you that the dollar was weaker than I thought. I would not have guessed the dollar would be where it is today, back in April. But the question is, going forward, if the Fed's raising rates, but the ECB is tapering their asset purchases, the Bank of Japan has hinted a little, but they're still going to target their 10-year at 0. Probably Bank of England's not going to raise rates again. Wouldn't be surprised if the Bank of Canada does, sort of in tandem with the U.S., not day by day, but over time. So I'm surprised that the dollar's gone down, and I would think that the dollar finds its footing here. Now, let's see what happens on the trade front. If you tear up NAFTA, if you put tariffs on the Chinese, if anything, that could maybe work to favor the dollar. There's that concern about global international competitiveness. But with the Fed raising rates, and with the U.S. economy probably outgrowing the industrialized world, not China by definition, and the ECB tapering a little, but not a lot, not raising rates, and the Japanese still targeting, 0, and the Bank of England probably holding steady, I would guess the dollar would go up. Not dramatically, but the drop in the dollar, I think the last basically 10 months, which has gone on through today, maybe isn't quite over, but I think it's searching for a bottom against the euro, the pound, the C dollar, and that, 6-9 months from now, I think the dollar is more likely to be where it's at or a little stronger rather than a continuation of the decline we've seen for the last 8 or 9 months. In fact, the dollar index, I think, is as low as it's not just 8 or 9 months. The dollar index, I think, is as low as it was exactly 3 years ago. So we're up a lot and down a lot, and we're kind of awash over what we were relative to the opening months of, in this case, 2015. And I think maybe that decline has gone about as far as it's going to go, other than what might happen in the next couple of days or weeks in terms of trying to find the bottom. Frank?
What about inflation?
What about it?
It seems like everything is pointing for inflation to increase, but we haven't seen it year after year. Is this what's happening?
I think we're going to see a bit more inflation. You're absolutely right. Wages have been steady, but that's a type of inflation. And price inflation has been under the Fed's target. I think some of this increase in oil, remember, 2 years ago it was $30 a barrel, gasoline was $1.80 national average. Today it's $2.60. Maybe, I don't think oil is going to go to 70 or 75 or at least not stay there. So maybe some of that push through, we've seen, you know, as much of it, although gasoline always goes up in the spring. So we do think inflation probably tops 2% this year, but more like 2 to 2.25%. Close enough to the Fed's target that they raise rates, but I'd still call 3 moves gradual, maybe even 4 gradual relative to periods in the past. And yes, we do expect a bit more inflation, both with oil and without, so-called core inflation. But to think that it's going to 2.5% or 3%, or is going to be something that would be well above the Fed's target in the next couple of years and require the Fed to really hit the brakes, which obviously would have potentially negative implications for the economy and for the markets, we don't see that happening as a result of a, quote, outbreak of inflation, other than the continued gradual creeping up to around the 2% target that the Fed would like to see. Yes, sir.
Do you see any effect from multinationals bringing back cash over the next couple of years?
Yeah, question about the repatriation. You know, we had the Apple announcement. Yeah, I mean, you have to like the market from that point of view. They're going to increase dividends, maybe do some M&A, do some buyback. Hopefully, pass, as we've seen, some of it in wages, invest in their people, invest in their equipment and technology. And there's enough that they can probably do all of the above. What the relative proportions are, we'll have to see. But when you have this kind of money that is coming back in, it does, as I say, in part add to the Treasury and reduce some of the other effects of lower taxes. And I think that's another positive from the economy's point of view, and particularly from the equity market's point of view, because companies are going to be raising dividends and doing buybacks and hopefully putting some of that capital to productive use. That ought to be positive for those companies and positive for the market, at least for the next couple of years, until probably the majority of them that are going to do it have already done it. Yes?
I'm curious, how do you feel the lack of a solid immigration policy and the retirement of baby boomers are affecting the labor market?
Question about immigration policy and retirement of baby boomers. I'm all in favor of retirement of baby boomers. And I have somebody very specific in mind. But we'll see. And you know, that is, the demographics is always a long run. The millennials are the biggest group now. We can talk about them and the baby boomers retiring. But I don't see, I mean, it's so slow. Most demographics are slow. So to say that somehow that's a problem for the stock market because baby boomers are going to cash out of stocks, I just see that as unlikely, especially in the next couple of years. So I think the baby boomers and the demographics are always very important. In terms of an immigration policy, I mean, you know, I'm not that fond. There was a good article today in the Wall Street Journal, I happened to be reading on my flight here, about the number of people that get visas and then overstay their visas in the U.S. And that maybe that's a better way to get here than, you know, than climb a wall or swim a river. That you get a visa now, you got to get it to begin with, but apparently there are more people here that are probably overstaying their visas, maybe that are coming in. So that, you know, it's sort of that's not an immigration policy, that's clearly a loophole. But I believe immigration is how we got here. I wouldn't be here if they hadn't allowed my great-grandfather in, and I suspect that's true for many of us here, great-grandfathers or parents or someone. So I think a more liberal immigration policy is good economically, good socially, and just the right kind of policy. So I'm not pleased, and I hope we don't throw 800,000 dreamers out of this country. There are many very productive people and are going to be hard to replace at a time when the market is this tight to begin with. So I can see that's why corporations have rallied around trying to say that is bad economic policy and is probably bad social and I don't know, argue somewhat anti-American policy. So I would rather see, I don't want to call it liberal, but I would like to see us actually have more visas, maybe try to police that people don't overstay them. Because I think in this type of tight labor market, which isn't going to go away for a while, we need working people, and often people who are not born here but want to come here end up being our most productive and patriotic citizens, and I guess that applies to the vast majority of us in this room. Yes?
If you go back to your Illinois outlook, which seems to be somewhat positive, what do you think the Illinois politicians need to do to enable that to happen? And what chance do you think that we have of them actually doing something that way?
The question was about what the Fed is going to do about interest rates. I think I already answered that. And it looks to me like we're out of time for more questions. I don't know the answer to that question. The question was obviously about the politics of Illinois and what your elected representatives need to do. It is, as I said, a bit more positive, although I'm specifically speaking more about Chicago than the whole state, because I, concentrated more on our forecast for the metropolitan area, which of course is a large part of the state. But I will punt and say that I don't really have a way to answer what your elected officials should do to deal with the problems and pension and other events that the state and Chicago are suffering from. Growth, though, is a good way to not solve by any means, but to try to deal with that in the next couple of years of job and economic growth in Chicago and across Illinois. Doesn't solve the problem, but I guess at least puts a little bit of Band-Aid on it for the time being. Any easy questions? I'm looking now for softball questions from the man in the back there.
So, non-political question. You haven't talked anything about the government shutdown and continuing resolutions. Is there anything that we need to be worried about? I think, and I'm no expert, it seemed like it's been a number of years since we've actually had a budget on the federal level. Is that ever going to come back to haunt us, or can we live on continuing resolutions?
Yeah, good question, and the fact that I almost forgot to mention it is how much of a non-event that I think it is. Are we going to shut the government, or are elected officials going to shut the government down at midnight? Ryan said they might have a plan. We'll easily pass the House. I don't know if it'll get past the Senate. So who knows? By now, I haven't checked my Twitter feed, but it may well be they pass something. If not, I doubt they're going to shut the government down, because usually they come up with something. So maybe it's another 30-day CR, continuing resolution. We've shut the government down, I think, 4 times since 1990. And basically, they've had no lasting impact economically, politically, depending on who the people playing or what they think is going on. It could have some real implications for the midterm elections. But if they shut it down a couple of weeks, my guess is they're not going to shut down airport, they're not going to shut down the military. You're still going to get your Social Security check at the beginning of February. And yes, it's going to be hard to visit a national park, and it's certainly a shame on us. But I think given the momentum the economy has, and frankly the cynicism that many of us have, that they'll shut it down for a couple of weeks to try to score points, and when they realize there are a pox on both their houses, they'll come up with another CR. And by the way, there was a budget. They had to pass a budget before they could do the tax cuts, and they could do it by reconciliation. But you're right, we may not see a budget passed again this year, and we will operate, if not on CRs, just on basically, kind of a continuity, if you want to call it that. But I think the stock market and the economy won't miss much of a beat, other than the headline risk of the government shut down for a week or 10 days or 2 weeks, and I don't think it would go any longer than that, because then we notice that we might actually get pissed off enough to say, you guys and gals better do something about this, this is ridiculous. So I don't think it would have any lasting impact. Well, I think we are out of good questions. Again, thank you very much. Good to be with you.